All right, good evening, guys. Ken at Tortoise Capital. This is the nightly strategy podcast for January 6, 2021. Subtitle, This is Why We Have a 25th Amendment. One thing I cannot stand is a bullshitter. But when he's got blood on his hands from the woman that died today, the last time I was this upset was 9/11. Absolutely unconscionable. So a moment of silence for a person who lost her life unnecessarily. All right, so these are the elements of the template that I need for the case study and trade frames. So I keep this in Snagit as a snag file that I can copy them all and paste them in. The only thing that's missing is the highlighted yellow box that I put into and I don't know why it didn't copy. But I have I have that yellow box that I make the yellow space like this. And all I do is I anchor this on the current price, and we'll remember that, there was like a weekly, a daily, an hourly trade frame, all of which, when these are in alignment and confluence, and it ends up inside a critical state, on whatever time frame I'm trading it, that's defined as, a greater than normal probability of a larger than normal move in either direction where the size of the move is much greater than the size of the yellow zone or the indecision zone, and that this that larger than expected or larger than normal move, I should say, happens in a shorter than normal period of time. So that's the very definition of a critical state. And it's a moment of temporary quiet. That little doji compression right there is a moment of quietude. As a friend of mine would say, it may be quiet, but it's like a long-tailed cat in a room full of rocking chairs. Mayhem could occur at any moment. And then the main idea is that when we frame that, we don't have a directional bias. If it goes short, then our job is to quickly get our risk out by getting to no lose plus dinner for two. Or if it goes long, our job is to be getting our risk out at no lose plus dinner for two. And then psychologically, all of this resolves into the same mindset that we would use for a science project. Let's see what happens. What else are you thinking about on a science project? Wear your goggles. Don't get burned. Get out of the way. report results, study results, form hypothesis, develop theory, produce rules, give to an engineer, do safe, professional work. Get paid. So that's what I mean when I say from here on it's just a science project. Yeah, it's a science project in that sense. So here's our yellow box. I identify usually three different price levels where an entry would be justified, because each one of these represents a test of a previous resistance level, and if it goes through that test, well, then it's voting on the way up. Like, for instance, this first one, price is leaving the yellow zone, and so that's information, because before this thing was mucking around in here, but now it's leaving the yellow zone. Okay, got it. Well, my risk is like always here if it leaves, because if this rolls over and it doesn't keep breaking out, but it starts rolling back into this, I don't need to see it come all the way to the far side and then leave. The simple fact that it came back into the yellow zone is all the information I need. So I'm giving it half. I'm giving it half of that yellow zone box. Once it votes its way out, I'm giving it half of that yellow zone box to work with. This is not a rule, but it's not unusual that by the time the second position is going in, that should probably be accompanied by the move to no lose plus dinner for two in some way. How could I justify keeping the original risk on if I'm doubling my position size? I can't. If I was going to do that, then I should just put the two positions on right from the get-go, but I'm already trading at a level of risk that is proper for that trade frame. So it stands to reason that by the time you get that second position on, you probably ought to be around no lose plus dinner for two, or I'll wonder why. And before you even put that second position on, go ahead and make your stop and move it from down here up to here. Get that locked in. And then the third position is something like, exuberance. And then the same thing on that one is that now, by the time I've got the third position in, adding risk, the gains I've made on the first two positions should cover the risk that I'm putting on this one. So if this third position goes on and then immediately rolls over and hits an exit, I should be able to come out of this whole thing with some positive expectancy, or I've put the third position on too soon. That's just basic. Don't get burned. Now, the choice of which exit to follow, whether it's the PSAR or move to the Bollinger Band mean and the Wu Wei exit, or to raise it up, stop, chunk by chunk, I don't care. Figure it out. Figure out something that you can do that lets you just get out of your own way, so you're not overthinking it. Pick one and use it, and then learn and adapt by studying the results. Report your results, study the results, form the hypothesis, develop your theory, produce some rules. Get on with it. Study that and make a decision. Once you produce those rules, give it to a quality control engineer on your team and make that process efficient and effective with continuous improvement using the Shingo model. The principles of continuous improvement. And then keep doing safe professional work. It's almost redundant because professional work is safe work. You don't break your tools when you're doing professional work. You don't harm people when you're doing professional work, right? And then you're getting paid for that work. So just accept your paycheck and get on with it. So mirror image to the downside, positions 4, 5, and 6. And then just for marking up my charts, I keep a couple spares ready to go, and I keep some lines on my chart ready to drag and drop so I can kind of quickly get through the case study, and then a couple boxes just to help me monitor risk and manage risk and do all that. So that's my production system for studying my results and case studies and setting up these case studies for me. That's all it is. That's probably a pretty good chart. I mean, it looks like a dog's breakfast, but call that and then name things so that you can find them again. ETF seminar. So this is a flashcard so that I will always remember that little speech. Flashcard. Science project. 2021-0106. That would be today. I'll probably turn that into an actual chart so that it's clean and readable, but you kind of get the idea. All right, to work. All right, speaking of work and getting paid, today in an IRA account, these were the gains from the swing trade positions on that list of speculative ones that we've been working. Those were the day over day changes in those swing positions. And that was the net. And I spent the rest of the day playing defense. Defense wins championships. But you got to be able to score the ball. All right. Let's see here. Yeah. All right, so today we made a new 30-day high at 377. You can remember just a couple months ago, this thing was at 320, and we were looking at 377 so far, far away. I wonder if we have that on a chart somewhere. There was a time as recently as, okay, so price was up here today at 377. There was a time 30 days ago, just 30 days ago, when price was down here at 360, a move to 377 to the far side of the RL or of the Z3 would have been a 3 sigma move, based on where the average price, where the 30-day average price was here. Price had already moved up into here to Z1, and on that day, a Z3 move would have gotten it to 377. So that's where that was. There was a time, excuse me, the end of September, when price was down here at Z minus 3, where it was that size of a move just to get back to the Bollinger Band mean, which it did in 10 days, and which it paralleled to Z plus 1. So there it went from Z2. It went from Z2 to Z2 in about 10 days. Then all the way back down here. So statistics will set you free from worry. And, so just look where we've been in the last quarter. Holy smokes. Well, why am I interested in swing trading? Well, that's why. I mean, this thing goes from here to here in a swing, swings to here, swings to here, swings to here, swings to really here, and all the way up to here. So this is what the Bollinger Band mean lines, what these Z envelopes produce for you, is the ability to kind of evaluate, the size of these moves. But remember, just 30 days ago, a move up here to 377 was a pretty low probability event, just based on normal statistics. It turns out that it got there, but, by that same token, it could just as easily have come down to 325. In fact, from this location, what was the greater probability event? That it would come all the way up here or come back to the Bollinger Band mean or down to Z minus 2? Well, if you take a look at the at this price behavior, this is the statistical normal return move right here. Would be a return to some kind of price level like this. Instead, it went to here, and now it's ground its way all the way back up into here. So this is climbing the wall of worry. Notice the way we've got the PSAR timed and tuned, that RL10 never crossed the PSAR. We never got a PSAR flip. On this one, we didn't get the PSAR flip until it protected us against 2/3 of the losses. The only exception to that was this one. And so you better respect the Bollinger Band mean exit, so the managerial exit gives you this exit. The sniper exit gives you that one. So the point I want to make here is that, we get caught up inside the little tactical cut and thrust all the time, but these Bollinger Band envelopes give us really important calibrated adaptive measurements by which to judge potential moves and to know the difference between normal and abnormal moves. So when price was here when it crossed the Bollinger Band mean to the upside, a move from there to 377 was almost 6 sigma. You wouldn't have bet on that on November 2nd. This was the day before the election. This is where we are now. That's like a 6 sigma move. And so the reliability of the indicators and the robustness of them to be able to handle normal noise and allow you to participate in abnormal moves with measured risk all along the way. That's the point of the RLCO Bollinger Band mean framework. So when I'm looking at the market health check here just on the 30 days, I want you to recognize that is connected to those larger time frames that we care about, whether you're just expanding the scope of the chart or you're going from daily to weekly charts or monthly charts or whatever. The interpretation is kind of always the same. So hopefully you found that to be useful. If you had a little moment of Zen or an aha moment in there, let me know in the chat box. Better, mark it up in your learning journal as something to explore, maybe to listen to and review and internalize. All right, so made a new 10-day, 30-day, and all-time high. That's what I think of that purple line as the all-time high. $10-day low just 2 days ago at 365. So that gives us a 3.21% spread on the 10-day trading range. 30-day low back here. Today it was actually down here, but since we're losing that day tomorrow anyway, I moved it up to what tomorrow's 30-day low will be, and that is at basically 359 to 377. Is $18, which is 4.77%. So as we're looking at the size of these daily moves that we got, 2 out of the last 3 days were these extraordinary moves. Here's what, from the peak, here's what that 2.5% sell-off looks like. Oh, to the Bollinger Band mean. Here's what a 5% sell-off looks like. Oh, approximately to the 10-day low. And a 10% sell-off, which is this one, is off the chart. So you tell me which one of these levels is noise? Is it a 2.5%? And where does it become a correction? Is it at 2.5%? That's what I would say. Anything that breaks below the Bollinger Band mean at this point is cause for serious alarm. In both cases, the plunge protection team came in, whoever that is, and bought it hard. Whereas it take a 5% sell-off. So you tell me which one of these is noise, 2.5% or 5% or 10%. It depends on your time frame and your theory of action. Jason asked me, do I think my systems will ever become less consistent as the market changes years from now? No, but it's possible. But the whole point of learning adaptive systems is to get better, not just hold what you have. I'm not looking to maintain the consistency. I'm looking to improve the consistency. The whole point of a continuous improvement is to get better, to get more dialed in. That's why you have to have a system that is, even while it's trading, so you got some work going on here in the black box. You got inputs and you got black box, and what comes out of it is R to get paid. You also have to have some kind of component that is involved in learning so that you can study all of these results, so that you can feed that back into improved rules to make the black box better. I don't know of a better way to do that than with statistics and math and continuous improvement with the Shingo model, because that's how you win the manufacturing game. So Jason, when the market changes, if the market is right here operating on whatever rule sets are going on, and you have some set of rules in here that are producing R's, and that market moves over to here, but your rule set is still stuck over here, you're out of alignment with where the market is. That's the problem. So the rule sets must have a feedback mechanism that is monitoring the market so that when the market moves, the rule sets comes with it. That's what adaptability means. So when you see the indicators and the analysis products that we're using, it's precisely to handle this, to handle that phenomenon. So yeah, every trade is a plan, prepare, execute, assess, so that I can follow my rules as they are today. And I assess that and say, did I follow the rules? And then what were my results? And then I assess the results, and then that trade frame goes into a database of many trades, so that when I'm studying the database of many trades, I can take a look at a histogram of results and say, oh, is my average expectancy getting better? Am I protecting myself against greater than 1R losses? Does my histogram results still look normal, so it looks like a repeatable process? And am I getting better than 2R wins once in a while? So if those things are true, if your histogram is correct, then you have actual evidence that the learning and the adaptation of your systems is attuned to the market, that you're actually learning from the market. But if your performance is getting worse, then your learning algorithms are out of alignment with the market. That's why you take notes. That's why you study your results. And that's why the law of large numbers of many trades and looking at the change over time tells you if you're working productively. So this is nothing more than statistical process control, production management. This is industrial engineering. This isn't horsing around. This is professional business here. You have to adapt that mindset, in my opinion, if you want to stay connected to a world that is getting increasingly dynamic. So that's a good question and a good comment. I'll tell you what, I'll tell you who's always going to lose is somebody who finds a really good rule set for today and then plans to use that for the next 30 years. I'll take the other side of that bet all the time. All the time. And I'll tell you why. Because the world, in my view, is filled with predators. There are tigers on the land, sharks in the ocean, and I guess what's the good, maybe owls in the air. That's the greatest aerial predator of all. That dude is optimized to win the battle in the air. Those apex predators get paid to eat herd animals without getting hurt. And if you have a good set of rules for today and you're starting to get fat, dumb, and happy with it, dude, you're being stalked with learning algorithms and machine learning and 24/7 AI. That stuff is on your trail all the time, every day. If you don't have that mindset, you're waiting to become a meal for somebody somewhere. So you better look around and ask, who is stalking me while I'm stalking my target? That's what the food chain is like. That natural process is what leads to consciousness and intelligence and problem solving. And that's what's wired into your human brain. So deal with it. Now, is that just a model of the world? Yeah, that's my working model of the world. It's just a model. It's not true. It might be useful. Might be useful. Play defense. All right, so let's take a look at what we got today. So yesterday was a recovery day and a digestion day, if I can say it that way. It took Monday's amazing day and it digested it. It was an inside day. It had a minor gap down and then did nothing but take off on the news of Georgia. And then the unhinged mob in D.C., and they should have shot 50 of them and not just one of them, brought the market down into here, and it's got the rest of the world wondering what in the world is going on. Life. All right, so here's what I'm seeing as opportunities to the upside. This is all tactical space here, and until it gets above 377, new all-time high, we don't have any new information yet. I would consider this to be the yellow zone of wait and see in between the RL10 and the PSAR cluster. So that looks like yellow zone to me. And then it starts getting troublesome down in here, and it's 2 scoops to the 10-day low. And if that breaks, Katie bar the door. It's 360. Could it get there in one day? You bet it could. It moved this far in one day without a civil insurrection in the nation's capital. So could it move from here to there in one day? Yeah. The worst overnight adverse gap in the S&P in the last 200 days was minus 5%, which times 370 is an $18 gap. So if it sold, 374 minus 18 gives you 356. So if it just had the same size downward gap as the worst gap of the last 200 days, this thing would open up down here. That's what the worst gap of the last 200 days would look like if we got that tomorrow. So if you're doing swing trades and measuring, your protection, your protective stops, and then using these close-in stops to max your position size, and then you get one of these gaps, that's how you get a minus 5R. Even a 2 ATR, which is about 2.5%, would have your stop down here. A 2 ATR stop, would be here, because this is where price is. A 2 ATR stop would have you around 364. Then if you got the 5% adverse gap, that would be minus 2R, and you can survive that once every 200 days or so. Nothing. That's why when you ask me what's my default risk management position size for swing trades and overnight is 2 ATR. And you should know for the symbols that you're trading, what's the difference between a 2 ATR move gap and its max adverse gap in the last 200 days. Because that's the one that'll cut your head off. So for the S&P right now, that number is 356. Why? Because of math. Math. That's all. All right. So, but if that doesn't happen, here's where I'm seeing sort of some natural support levels. If we don't get that, the 2-day low is here, the belly of the dragon is there, the PSAR cluster is in here, Z1 is there, this width of the dragon here, this is really legit yellow zone inside here. So for me, this, I would say, the PSAR dots, those are important ones. I could live with the 1-day low or the 2-day low, but you can't let it go. If you are long this position here, you can't let it go below here, or you're just giving up all of that gain. And if this fails, here was one test and they bought it right away. You going to bet on that? And then if that fit, there's no support in here at all, except for this last little, that little buying spree, and that was 30 days ago. You think that's going to give it support here? Maybe. I don't know. So for me, tactical stops got to be in here, and I have to adopt a downside orientation. If it breaks out of the Z-1, that's the edge of normal behavior right there. It just happens to coincide with 365. So this width of the river in here, that's the range of normal price behavior. So all of this stuff up in here, these were abnormal gains. This was great. That was 10 days in a row of abnormal gains. But there was no people's revolution going on in there. All right. End rant. Let's see what happened. So the S&P up 0.58. I'm amazed that it stayed up that high given the assault on the Capitol. There's diamonds at 1.43. The Russell up 4%. So TNA was up 12%. The Qs down 1.4. And so was XLK Tech. And Treasuries down 2% as the rest of the world wonders what is wrong with us. And I wonder that myself sometimes. All right, let's take a look at what underperformed sector-wise. So oil minus 0.5. Wheat and precious metals 2% or 0.2, I should say. Let's see. There's Brazil, the VIX, emerging markets minus a third to a half to 2/3. Silver minus 1.3. Tech, S&P Tech minus 1.7. Amazon, Microsoft, the FANGs, Apple, Palantir, Neo, NVIDIA, all that getting smashed. What worked? The ARC Genomics, so that's the biotech. Japan and healthcare, 1.2 and 1.4. S&P biotech, 2%. Simon Property Group is commercial real estate. Energy and Mexico up 3%. Oil exploration, 3.88. Basic materials, 4%. So Tesla's 2.8. Yeah, that feels good. Materials were up 4%. U.S. Steel was up 17%. Take a look at the trade frames we did this weekend on U.S. Steel when it was back around 12, I think it was. This is the trade frame we did this weekend. It was right there. And we said if it broke out above that box, out of that doji, and then if it broke out above our target, our first target was here to the top of the box and the Z1, and then that's also the hump of the dragon, and then we said to the top of the RL10, and then to the all-time high, and then your risk box is the size of the doji. So that's 1, 2, 3, 4, 5. That's about a 6R move already. So U.S. Steel at times acts like a growth stock. All right, here's finance 4.5, Devon Energy 5.5, Clean Energy 6.16. There's your Bitcoins and Ethereum 7 and 11.5. Those were up at 20% at one point on the intraday. Yeah, we're not going to do the bar by bar tonight. I need to watch that House and Senate as well. But some quick ones I want to just share with you today. All right, so you need to study this flashcard. So this is Cliff Natural Resources in the morning, and these two boxes here are simply the hybrid frog frames with the minimum manageable risk box. That size of that box just comes from the Z3 pinches of the day before. So it opens right in between those two boxes, and it breaks out to the upside about 5 minutes in. So we buy it at the green dot. It has about a 20-cent risk box right there. The Wu Wei exit is this red line. It stays in place while price is moving up. It stays in place right here until you get 1, 2, 3 PSAR dots above the entry. Then you move it like a sniper to the PSAR dot, and then that stays in place until the Bollinger Band mean, which is here, the dashed red line, picks it up. Now you adopt the Bollinger Band mean as the exit management, and you take a managerial exit here. And this risk box on the first position, there's 1, 2, 3, 4, 5, 6 R on the first position. This was a Kata 2 where you had a pullback and it resumes. So the RL10 dips in and comes right back out. That's a supported fall crossing because the RL10 went from the summer into the fall and then crossed the RL10, or the RL10 leaves the dragon again. So you buy it, Kata 2, add a position, Kata 2, add a position. So the second box gives you 1, 2, 3, and then the last one gives you 1, so that's 4 plus the first 6. That's what 10R looks like from 9:30 until 11. Until 10:45. That's what 10R in 1 hour looks like. Okay. This was the swing trade in NEO that we framed up. Now maybe we'll do some bar by bar. What we noticed in NEO was this consolidation, a breakout, consolidation, breakout, breakdown, consolidation, and then we got a critical state here as the Bollinger Band means are pinching, and we've got this little framework here. So we just do what we do. Same thing to the downside. almost perfectly calibrated. So you buy it, add a second position, so where is your stop? It's still in. Why are we still in? Because your initial risk is here. PSAR is not out of the valley yet. Oh, sorry, that entry was there. My fault. So by this time, would you be wrong in saying I'm going to move my stop to here? Or here? Wouldn't be offended. So that's not a bad place to be. Since this is on daily charts, I am not offended if you take your exit somewhere up in here and then re-enter down in here when you get the second RLXD. But that's if you're using end of day charts right there. If you're using hourly charts, this is easier to see. But that's what swing management with the, even if you adopted just the PSAR exit, and if you weren't trying to get extra positions on in a hurry, that's manageable. And in this kind of a market, I wouldn't be offended if you took a 2-bar low exit right here and made bank. As long as if you're going to be that aggressive, you get a re-entry in here. So there's a possible swing, and here's a re-entry, or you're still in because you're using. So everything on this is exit management and not the entry. These entries are rock solid. Like that entry here is the same logic that gets you in here, and oh, that never even looked back. Those Benz and the Dragon are your friend. Here, I think, is an intraday. It doesn't even matter because they're all fractal. So if you set this up, pick your trading plan. That probably gets me out. This gets me back in. You've seen that a dozen times this past week. There's my exit. Sniper exit. Fractional loss. Big gain. There's a re-entry. How about that? Lock that in. So that's an ongoing trade. You could live with that. All right, Eugene, here's one for you. This is this was the opening bar right here. It opened at this that intersection of those two risk boxes. Those two risk boxes are the size of yesterday's Z3 pinch box. So after that first box, right? So that's okay. Hey, Eugene, I need you to monitor this one for me. I make the entry for you, and that's the risk I'm willing to. Don't let it go below the VWAP, and then you can keep half of everything that we make on this one. Okay. I'm going to move this bar by bar, and then you just tell me where to put the stop. So that's my initial stop right there. Okay. I'm going to try to draw my line straight. Just a minute. Does that look correct? I think that's the way you like to trade it, with that trailing box. All right, so locking in gains. Still liking this? This is what the sniper in me wants to do, like a 2-bar low. The sniper would be out. You're still hanging on by the skin of your teeth and out. All right, that's visual box trading right there. This is the this was the warning shot right here. That's the thing that triggered me to move a sniper in. I was very close to just saying, give me a 1-bar low, which would have made a micro improvement. Notice that without your routine rules, you end up giving back the green box of gains all the way to the Bollinger Band mean. So this one's kind of interesting. Now Eugene gets to have the fun on this because he suffered through all of the hybrid workshop last year. So here's one where the symbol closed here, gapped down to here. Intraday went as high as to the PSAR and the Bollinger Band mean, came all the way back to here, and is now settled right on the opening. Yeah, so it opened here. That's what that dotted blue line means. It opened here, ran up, ran up, ran back, and is now poised right at the opening. Okay, so that's where we are. So the two yellow boxes, this is each of these is that Z3 pinch size box. So you have one in case it goes north, and in this case would break out of the river, and this one, if it breaks down, an equal distance, but you'll notice that that would be slightly below the Z3. Okay. All right. So Eugene, give me the what is your entry on the south side, and what's your entry on the north side? This is if we're using the hybrid frog right there. So okay, Z plus 2 on the upside. How about on the downside? And Z minus 2? Oh, plus or minus 2. Okay. And then are you going to use the standard, like a standard stop here? Yeah. What I like to do is get a short right here. As if this was the box to get a more refined entry, but same thing. So in that case, I would like to be short there. You're short here. This dotted blue line is your exit. I'm going to get mine out of the way. Okay. Yeah, the blue dash is Z minus 2. Yeah, so this is where all those Z's are. So here is the Bollinger Band mean. So that's Z0, Z minus 1, Z minus 2, Z minus 3. Okay. Price has moved. It continues to just weasel around right here. Price has now come back to your short position. If you were following the Bollinger Band mean extension, that would be your stop. If you were following like the PSAR, the PSAR extension, you might pick that as a stop. If you were using the PSAR just straight up, or the Z1, you would be like right there. Okay, so Yeah, one would be the you would just commit to the Bollinger Band mean. Two would be commit to the PSAR. Three would be the current PSAR and hold, but without trailing. You're just making an adjustment. Four would be the uh, Z minus one. So, okay, you got stop on the PSAR. So your stop is at 3. Prices now move down to the yellow dot. A trailing PSAR would be there. The those of you using the PSAR following the PSAR would look something like that. So I'm just going to keep drawing that as the extension of the last 2 dots. The Bollinger Band mean extension is still pretty good. That's like this. I would understand this. Spine of the dragon is no lose plus dinner for 2. That's 7. Yeah, you make a good point that if this was Lisa, she'd probably already have. She'd be looking at adding, I think, a position like if it broke below here. She would call that a short, or here you could also do that one. So if you're playing along at home, you could decide to get short on a new low of the day or a Z2 breakout. And if you were that kind of person, you might also say, well, I would automatically add a breakout at 10, right? So on this one, I kind of like 7 as a static stop. Oops. Until it like picks up the PSAR in this case. So I would like kind of a combination of 7 and then 2. Yeah, or yeah, a 3-bar high would be just north of 7 a little bit. It'd basically be where you entered. And so in my view, if you were going to take a scratch, like here at I'm going to call that 11, the thin red line, I would just take the exit at 7 so I could at least pay for the trade. Um, a really aggressive one would be this, like a 2-bar high. At 12. This feels like a really important moment right about here. Man, it's killing me. So all of that's still in play. I might move the 7 down to here. So I still kind of like 7 and 2. That's like the RLXD. And then 2 adjusts that stop just a little bit. You know, the Bollinger Band mean extension. It's kind of this. Yeah. I think I would add it not later than 9. But I could see how a person would do that. Where do you have your stop at, Eugene? I like 7 and 2 as a strategy. Uh, let's see. So you're putting a second position short at 8. So basically, second short here, and then a stop at the top of the dragon. Yeah. Okay, price has moved down into here. You can feel that PSAR flattening out. And I'm almost ready to do this. Sorry. Almost ready to make that a move, because you can see the RL30 is starting to roll up now. This is really failure to collapse. So I would not object to getting out there at this yellow dot, especially if you got a second position in. You know, that's about a 1R gain. So 1 is still the declining Bollinger Band. That's a reasonable third position. I'd be willing to put that like at Z1 right there. I like I like a stop at 2. And another position at 12. Yeah, and that's the difference. I mean, it's not much of a difference between the PSAR dot and the top of the dragon. But I think you've got to decide if you were out. So if you covered there, you got to decide if you're getting short anywhere in this area. Certainly by 10. So prices down here. I get another short position here. I think I got to be there. And now that I got so much on this thing, I'm going to use the top skin of the dragon once it picks that up. I think that's my trade there. And this was essentially where I got short here. I'd be willing to accept that as the short. And the main reason here is I've got at least 4 positions in. I either have this one or this one short. And it's that just feels like it's enough. And I think, yeah, this is where I'd be willing to get long. And this is where I would be willing to, re-enter. There. So short here. Put my stop there. That's sort of a sniper stop to lock that in. I would take that. 5 bars and it failed to fail. And then you notice that it's got this this little RL, the RL10 has rolled up across the baby dragon. Price is entered there. I would probably be willing to get long at the second dot here. So there's that next trade in the series is right there. And now what I'm noticing is this, you can really see that return to the VWAP way up there. But at the same time, boy, this shirt feels attractive. So I think I'm going to do that. If it breaks down one more time. This one, I think I want to tighten this up to the hump of the RL10. So long. All right, Eugene, you're in the trade now. You are on the stop that I told you, don't let it go below that red line. And then you can adjust the stop from there. Okay. I'm hoping that it gets to the VWAP. I'm not going to add a second position until it gets above the VWAP. Okay. So you're going to trail with the PSAR, or no? Wait a minute. Let me ask you. If you're playing along at home, you decide. Okay, there it is. There it is. And probably if you waited for the original one, it's probably there. We never got the the PSAR dots. We always like looking for the 1, 2, 3. It never happened, and then this is where the PSAR flip occurred as it gets into the Z-3, or the Z3 pinch, I should say. So if you said, if you decided to take this one as a scratch, I would not be offended by that. So total deal of the day here on this one. This turns out this was the inverse volatility. So there's probably on this trade, there might be 2 or 3 R in there. There's probably an R here. This is probably a fractional loss. Here's one from the chat room today. Really nice work from Shahab for 8.7 execution R. He gets the supported spring crossing. He adds the, his stop is here until he gets 3 dots above. Leaves that in place till the Bollinger Band mean picks it up. gets here, he adds, oh no, this is not Shahab, this is Luke. So he adds on the second, third, and fourth entries on the dip, kata 2 entries. So there's a kata 2 entry, there's a kata 2 entry, there's a kata 2, and then there's the managerial exit. 8.7. That sure is easier than the way I'm doing it. Doggone it. But you take the point. Okay? All right, that's everything I got for you guys. I didn't get to the ones from yesterday. God dang it. That's already 9:48. All right. Need to get you a chance to prep. So take good care, guys. We will see you tomorrow. Ready to go. 25th Amendment. Troublesome times. Take care.